Hi, everybody. Welcome back to week 8 of the Online Investor's Guide to Thriving. Wow, 8 weeks into lockdown and an economy on pause. Even as case growth drops and controversial plans to reopen the economy in phases roll out, one part of the picture is really coming into sharp focus. This is not going to be a short-term thing. We seem to be in some sort of eye of the storm right now. Things almost seem calm and under control. But what likely comes next is the realization that coronavirus is going to be with us for a while, likely in multiple waves. And when that restaurant or store reopens, it won't be to 2019-like sales. So why then are markets so buoyant? Multiples in some sectors haven't been seen since 1999. Well, tonight, Larry will do his best to help us make sense of it. I'll remind everybody in week 1, when we started doing the Online Investor's Guide to Thriving in replace of our live events that we usually do this time of year, I cautioned attendees that we don't have a crystal ball. And that's really true. For those of you DIY investors out there, don't inform your whole strategy around what Larry thinks and try to trade the noise, because we know market timing never works consistently, which is why we want to help you understand how to tame the market instead. Our approach is to constrain outcomes for clients so we get the risk return fit right for them, and they can get some yield, earn some yield in the zero rate world, dampen equity volatility, and do all of that while we just wait for more clarity, because no one really knows. So if you need a little help navigating markets and financial life in general, Larry and I founded ETF Capital Management to provide portfolio management services to clients with a need to manage $1 million and up. And we've partnered with BMO to offer ETFs and funds of ETFs for those currently building their first $1 million. We also came together with Monique Madden to bring you U Potential, which is a professional fee-for-service with planning-only mandate. For those who simply want to catch the webinar replay or download Larry's slides from this evening, tomorrow morning you'll get a short email survey from us to tell us how we did. And if you complete that survey, you'll get a link to access all of the above and submit questions for next week. As usual, Investor's Guide to Thriving comes to you at no cost. We do this because we want to support 2 charities, very important to Larry and I. Those are Sick Kids and the Baycrest Foundations. We hope you can join Larry and I supporting childhood leukemia research at Sick Kids, as well as the research that Baycrest does. They're global leaders in research into treatment of Alzheimer's and dementia. So for those of you who have made donations, we thank you very much. For those who would like to make a donation, please use the links in the survey you'll receive after the event. That's how Larry and I know which donations to match. Thanks also to our sponsors, National Bank Direct Brokerage and BMO ETFs. BMO ETFs was the very first and to date the largest supporter of our investor education at Investor's Guide to Thriving. They're a great partner in ETF education, and we're constantly impressed with the high quality of resources they make available to investors. Speaking of a great resource for investors, it's my pleasure to introduce, all the way from the West Coast, Renee Dinter from BMO ETFs.
Thank you, Jared. And hello, everybody. Today, what we're going to do is hopefully set the stage by highlighting some of the benefits of sector-specific ETFs, as well as provide some actionable ideas for the current market environment or to execute on Larry's outlook. And at BMO ETFs, I work with investors of all shapes and sizes, so everyone's application of these ideas will be slightly different, but hopefully this can arm you with some great information. Let's start with why ETFs for sector exposures. Using an ETF provides instant diversification, allowing you to spread the risk over a variety of stocks within that sector, especially if you have a finite amount to invest. The example up on the screen, Amazon. Share price trading at approximately $23.50. If you were to buy that individual stock, one share costing $23.50, imagine purchasing a board lot of 100 shares in order to use stop losses for your trading. That would cost a minimum investment of $235,000. An alternative way to get exposure to some of these household names in a diversified basket is through sector ETFs. in this example, Amazon, you can buy this through the broad market. If you were to use the BMO ETF ZSP for the S&P 500, it trades at only $43 a share, and it gives you approximately 4.5% exposure to Amazon. Another way of getting exposure through a broad market ETF is the NASDAQ 100, and that offers approximately 10% to Amazon and trades at about $66 a share. Or if you want to get more targeted, and for the focus today on sectors, you could pick up Amazon shares through the Consumer Discretionary Index, where our ETF DISC trades at $22 a share and offers a 12.5% weighting to Amazon. This highlights kind of the benefits of using a sector ETF to get exposure to some of the names you love. Now that said, when selecting the right sector, you'll notice from this chart that leadership changes depending on the macroeconomic conditions. So picking the right exposure is very important. Identifying the right sectors can lead to outperformance, sometimes over longer periods, when those sectors are driving the overall market higher. Think about how technology, communication services, and healthcare have been driving the market higher recently. And the other thing to consider is when selecting a sector, you also have to be pretty nimble. As you can see from the chart here, leadership does change from time to time. So being nimble is important, especially when you consider the timing of your exposure based on in more cyclical sectors like energy. For example, if we look at what sectors do well in various macro environments, the sector investing example, here is a breakdown of the sectors that tend to do well during different economic regimes. And so you can see today if we're going into a recessionary environment, or I'm looking forward towards an early recovery, I can identify which sectors and ETFs that track those sectors will give me the exposure I desire when I'm positioning my portfolio. It'll be really interesting to see which sectors perform well coming out of this recession and moving into recovery. Inevitably, it will happen, but the key is every crisis is slightly different, each bringing on their own specific considerations, something you need to be aware of, and when you're identifying which sectors will do well into the next cycle. Also, once you have identified a sector that you want to be in, consider the portfolio construction. The construction of every sector ETF will have a large impact on its performance, not just relative to other sector ETFs, but also relative to the broader market. And not all sector exposure is the same. Here are some things to consider. The most common approach to building a sector-specific ETF is to go with a market capitalization weighted methodology. This means that the biggest companies in the sector will dominate the weighting. As I used in the example earlier, Amazon is the biggest individual holding inside of the consumer discretionary ETF. It offers a lion's share of exposure because it represents the biggest market cap weighting among its peer group. Another way to consider construction is an equal weighted methodology. Equally weighted methodologies, like we use in our healthcare ETF, equally distributes the allocation across every name in the portfolio. This allows you to not only mitigate the risk of one name outperforming another, it spreads the risk by properly diversifying across the sector, but it also tends to have a smaller cap bias so that smaller companies in that sector are given more exposure in the ETF. Those I think are the two key ones to consider. And then, of course, there are alternative market capitalization. This is different methodologies, different ways of calculating market cap. The one example we have up on the screen here. The other one that I'll mention, especially given that as Canadian investors, we're looking for sector exposures that may include a lot of US or global companies, currency will also impact returns. So once you've found the sector that you're interested in, also consider whether you look to a hedged or unhedged ETF. Because whether you want or don't want exposure to the underlying currency of stocks in the US or globally, they will have a huge impact on returns. A good example would have been in the most recent pullback. We saw a huge appreciation in US dollars, which means if you were in an unhedged US sector ETF, you would have benefited from that currency exposure on top of being in the right sector. So things to consider when analyzing various construction of sector ETFs. Now let's put it all together. Most investors already have a core portfolio, and the most common approach to using a satellite is thinking of it as a sector, is to think about it as a satellite position. A satellite position complements your core portfolio. It allows you to either exploit market opportunities in the current cycle, or a good example would be healthcare currently, given the nature of this crisis. Maybe I want to overweight my portfolio with healthcare. Well, I will create a satellite position and I'll add to it a healthcare sector ETF. Or in the context of a larger portfolio, maybe given the increased volatility, I want to tilt my overall exposure to be more defensive. And so I'll look for a satellite sector ETF that gives me exposure to less volatile sectors like utilities. And as we come out of this current environment, maybe down the road I'd like to get a little more aggressive, and I'll switch out my satellite position and be very tactical out of utilities and look to energy or another cyclical part of the market. And finally, one other idea, for those of you looking at sector rotation, what you can do is create a satellite position and rotate it based on sentiment, seasonality, or other fundamental factors, possibly even some outlook from Larry himself, and decide, how do I want to change that satellite and rotate it from one area of the market to another? I can do that in two related sectors and switch back and forth depending on my outlook for the current market. And a very popular one among professional investors is this idea of switching between consumer discretionary stocks. When I'm looking at the increased consumer spending, I'm looking at the underlying stocks benefiting from spending into year end or around Christmas time, I want to be in discretionary stocks. Then I'll rotate my satellite position into consumer staples because I want to tilt my portfolio to become more defensive. I'm assuming that consumers aren't buying luxury goods. They're going to be buying more of those must-have items like groceries and so on. And so I can basically rotate consumer spending habits based on fundamental outlook and or seasonality without really changing the nature of my overall portfolio construction. So this simple idea of factor rotation is very popular, and you can do it with related sectors, or you can use very unrelated sectors, like I mentioned in the previous example of looking at a highly cyclical sector versus a defensive one, energy versus utilities as an example. So hopefully that provides a little bit of insight into some of the tools available. Of course, all of this is available on our BMO ETF roadmap, where we have a sector roadmap that allows you to choose which ETFs are right for you. And that's all available at bmoetfs.ca. Thank you very much.
Okay, thanks very much, Renee. And thanks again to all our sponsors for making these virtual roadshows available to everybody. I loved for 10 years now, and hopefully one day when we get past all this, we'll get on the road again and see people. But like they've said from day one here, it's the virus is going to tell us when we can do these things. It's very, very interesting here in Ontario. Premier Ford announced the golf courses are going to open Saturday. I'm very excited. I'm an avid golfer. I'd be playing every day if it was practically possible. I love the outdoors, social distancing, but they're going to make the tee times 15 minutes apart, and they're going to do all these, kind of things where we'll see. But if someone's asymptomatic and you're still within spitting distance, as they say, so we're going to have a second wave here. That's the thing. Governments of the world, with the exception of some Southeast Asian economies that have been more familiar with these kind of crises that were more localized historically, we're far more prepared. And even in some of those places, they're having aftershocks. And so how do they deal with them? The US is not equipped very well in how the economy is developed to deal with crises like this. And I'm afraid there's going to be a pretty significant second wave. Now, I don't know, maybe they come up with a viral treatment, but the smartest people on the planet, fingers crossed, say January, we'll have a vaccine. I'm not an expert, right? But from the expert opinion that I've read and studied, I don't think so. But I'm not going to talk tonight about the problem and the issue. What I think is a bigger issue is the moral hazard that the largesse of the governments have created, not just to combat COVID-19, but since the very first bit of volatility that we weren't ready for as the markets were melting up in the late 90s, long-term capital blew up. It was a big hedge fund, and there was so much leverage, and so all the central banks got together and cut rates. And if those of you who study history understand that event became known as the Greenspan put, and pretty much every central banker since has used that put. So we're going to talk a little bit about moral hazard. I'm going to look at some of my picks. We'll talk about fear and greed and take a deep dive on my shopping list. I want to leave a lot of time for questions today. We've got some that have been sent in, but I want to get to as many as live. I have the gift of gab, unfortunately, and I don't have to answer in 30-second sound bites, so I take way more time than I should, but I do want to leave lots of time for questions. So Jerome Powell, when he was a Fed governor years ago, and Bernanke first said, we got to do this QE, we got to stimulate. He said, I'm only going to support you, Ben. And I know someone personally who was in the room that heard this. And I've had her on my show before, a woman by the name of Danielle DiMartino Booth. He said, Ben, I'll support you on this, but we've got to be able to unwind the balance sheet. And it was, oh, yeah, this is only temporary. This is only temporary. Don't worry about it. And so we've gotten to this point now where even the guy who didn't want to do this is now forced into doing it. And I imagine he's cringing. But what he said yesterday in conversation And he was asked by the gentleman from the Peterson Institute about going negative. And so on the bottom part of the chart here, I've got the Fed funds futures contracts as they trade out into 2021, 2022. And you can see once this goes above 100, the way a euro dollar or Fed funds contract works is it trades like a T-bill. It trades at a discount. It's issued at a discount to the refunding rate or the redemption rate, which is always par. And so when it trades above 100, above par, it's implying a negative rate. And as you can see, as we get into the second quarter, third quarter, fourth quarter into 2022, there is an implication in the Fed funds futures curve that people are speculating about negative rates. And Powell was asked yesterday, the gentleman at the Peterson Institute, whose name escapes me, and I apologize for that. And Powell said, well, we're not considering that as a policy tool for now, ... for now. And the markets kind of took on that and said, But the magnitude of what he said, he cited a study that the Fed put out today. 40% of young people can't afford and are in a very, very precarious way. This can't logically be a V. And we've had a plethora of high profile hedge fund managers and the like come out and say, this is getting ridiculous. But I'm going to show you some charts that this is completely normal behavior towards the end of the portfolio. But the economic recovery here can't be a V. And for the markets to portray that, for the narrative of the strategist and the analyst who have a conflict of interest, we in the financial services industry sell, buy. We don't sell. We get paid when people have assets with us and we make a management fee. That's how the whole industry works. And so there's an inherent bias to be optimistic. And I've been, you can call it pessimistic, I've been concerned for years and years because what's boosting the market is artificial. I debated this out with David Rosenberg last week, and if anybody missed that, I would highly encourage you go to the Investor's Guide to Thriving website and watch the replay of David and I talk about lots of things that are, say, somewhat artificially boosting the market here. But it's the moral hazard I want to concentrate on this week, and that is, how do we get out of it? How do we get to a world where we can back out of this and do what Powell wanted to do? Because, the Fed tried raising rates and they added 200 basis points, 250, and then the world had a stroke at the end of 2018. At the same time, Trump was being Mr. Tariff Man, tweeting, he was going to raise tariffs on China, and then they had to cut all through 2019. And the market loves an easy Fed. And we had a great rally last year with no earnings growth whatsoever. In fact, we haven't had any earnings growth, real earnings growth, not the pro forma BS that companies report, but we haven't had any EBITDA, bottom line, tax reported GAAP earnings since 2012. We haven't had any growth. And you can look at the national accounts data. 2 months ago when we first started doing this, I had that chart. I don't have it today, but I had that chart in the presentation. So the ECB's been using negative rates. You remember Draghi said, believe me, it'll be a big atomic bomb and we'll switch national bank, like everybody's been doing this, Bank of Japan, and they can't get out of it. And we have this marketplace that now forces the central banks into doing this. So the question is the moral inference of that inverted yield curve and the president's belligerence towards the Fed, which he did again today and yesterday by saying, hey, the rest of the world has negative rates, we should have it too. Is that going to force them, even though they don't want to do this, into a negative rate environment. So what I've done here in the chart on the top is I've picked off some banking ETFs. So one that trades in France, it's priced in euros, BNK, FP is the French index acronym for Bloomberg, trades in euros. And the total return since the beginning of this graph, which you can see there is October 2009. The reason I didn't go back before that was because this was the longest ETF that I could find that tracks the European banks and then the Japanese banks. So those two, the one 1615 JP is the Japanese bank. And so here's what the world banks have done in this last decade coming out of the crisis. And the answer is crap compared to the US long bond, TLT, which has been the best performer. So Canadian banks reasonably well, the regional banks a little bit okay, 5.77 annualized total return. Canadians at EB equal weight Canadian banks 7.15 annualized, total return. And the US long bond, for all its issues and all the debt problems, 8.64. Now, those numbers aren't going to be repeated going forward. I can promise you that. The bigger banks, so KBE, which is more a broader, larger, would include some of the JP Morgans as opposed to the regional ones, Fifth Third Bank, and so forth. And this is what negative rates and low rates and in flat yield curves mean for banking. And I hope we don't go there, but if we do, you can expect, it depends how long we stay there at negative rates, you can expect the Canadian banks and the US banks, frankly, to get crushed, would get cut in half from where they are today. And if you don't think that's a very real risk, they're going to tell you they're not going to do it because the proof is on the pudding. But if they run out of, if we do get another swing down, what are they going to do next? They've already spent trillions and trillions. There is not enough money to fix all this, guys. There isn't. Now, theoretically, there's no limit. If we look at the G4 central bank balance sheet as a percentage of GDP, the Fed, the ECB, the Bank of Japan, Bank of England, we could throw in the Bank of China into this too. I saw a graphic on that today. We're at 60% debt to GDP globally that's sitting on as assets on the balance sheets of the central banks. And we're in a world going forward where we can't grow out of this. The demographics of the world, David and I discussed this a bit last year, between the number of people in the workforce, so ages 16 to 65, compared to the 15 and under that aren't working and generating incomes and are a cost to the system. And generally speaking, the people who aren't working anymore above 65 and are still paying tax, but not at the same levels they were when they were earning income, but now withdrawing money from their savings to live off of. So there's a dis-saving in that regard, pulling money out of markets to live off of, is getting worse and worse and worse. And those demographics are going to be with us for decades to come. So we've got a massive growth problem. And historically, the way out of this is to inflate or to grow. And I think we need to reconsider how the world measures success, because the president of the United States today pounds his chest and tweets when the stock market goes up. And frankly, that isn't helping the average person out very much at all. In fact, the whole experiment of trickle-down economics and the idea of GDP needs to be rethought. And I would love to take a whiteboard to this, but I think where we're heading, I think as Main Street gets upset with the people that have been leading us, whether that was a decade ago and mad at Wall Street, or this time around mad at governments for not being prepared, we've got a massive sea change coming. more popularism, more candidates giving more extreme views, Bernie Sanders, Donald Trump, but it's all over the world. Italy is about to fall apart politically, and we're on the doorstep of that, and I'll talk a bit more of that shortly. So I think it needs to be about the people again. I think it needs to be about the average person, and you're going to see taxes go up, and we're going to get into this economy that isn't the best ever, and it's going to struggle. But I'm not sure that that's terribly a bad thing. A couple of years ago, Jared and I set up this company called U Potential. And what U Potential is the independent financial planning arm of our group of companies, and Jared mentioned that at the outset. But it's about, it's about Joey saying, how you doing, right? So the idea of well-being as a measurement of success, as opposed to GDP and how the stock market is doing, I think is where we're heading. Now, you might call me a communist, you might call me a lefty. I can assure you I'm a capitalist, but I'm an analyst, and I analyze and I evaluate and I look at the most likely scenario given all the inputs that I look at. And I see this massive amount of debt, the problem with demographics, the promises that governments have made cannot be paid for. Simply cannot be paid for. The debt will have to be monetized. There is no way out. I will debate anybody on the planet on this topic. And I welcome great ideas that are different, absolutely. But a number of years ago, an increasing group of people, and this website here sponsored by the OECD, which is the Organization for Economic Cooperation and Development globally, the developed nations. And they created an index, there's lots of different versions of this, that asked a simple question. Is life better for you? How are you doing? What is your potential? What can we do to help you live up to your potential? Because I believe that's what government's job is. If you're a libertarian like I am and believe that government should be a small part of the pie, government's going to be bigger than it ever is and growing so because we didn't plan well. The people that have been leading us didn't plan well for a crisis like this. And it's going to be the virus that dictates. And let's hope we get a vaccine, but let's hope they plan better for the future. And they really haven't governed our tax dollars very well at all. It bothers me to no end when we get fiscal waste, and there's plenty of it all over the place. It makes me sick when Nancy Pelosi put in $25 or $30 million for an upgrade to an opera house in Washington, D.C. on the last bill that was passed for COVID-19. Now, does that make you mad? Does that make you really upset as a taxpayer? It does to me, guys. It really does. So, I think the world's going more towards this and saying, do you have affordable housing? Are your incomes rising? What kind of jobs do you have enough training to get you a better job? What is your community like? Is there community support? Is there outreach? Is there support for mental health? What's the education system like? I think a lot of reasons why people vote for Donald Trump, I hate to say it, but I've heard it said by some geopolitical people recently, is because of a lack of education, frankly. And I don't mean to offend anybody at all with that statement, but I think the quality of our education isn't what it used to be. Environment's very important. Can we breathe clean air? That's a pretty important gauge of how well we're doing, and so forth. So your civic engagement. I mean, half people vote. How awful is that when you think about it? We live in the freest countries in the world here in Canada and the US so far, and half the people vote, where people go to war for that, right? Think about it. So what's your civic engagement? Obviously, health concerns, life satisfaction, safety, work-life balance, etc. So I think we need to move to this model of success. And I've said that I have a political future. If I'm ever senior in politics, I'm going to push forth an agenda like this. I mean, part of it is incomes, part of it is quality of life. It's boosting the stock market in part, but that shouldn't be the whole focus. Which almost every decision coming from the Fed today to support the system is about boosting the stock market. And that's not really helping the bottom half that have no exposure to that. So I really think this is important. I want the discussion to be had. I started talking about this a few years ago, actually, in the BermansCall roadshows. And if you're a regular that comes out to our live events, you might remember 2 or 3 years ago, I introduced the well-being indexes and started talking about that. Let me talk about Europe because it's about to implode. So in theory, there's no limit except when there's a constitutional limit. So the German Constitutional Court voted recently and basically said that the ECB's bond buying program could be illegal. And then Christine Lagarde, who's now head of the ECB, basically said, screw you, it's not illegal, blah, blah, blah. So within the next 3 months, we're going to get to a point where basically the Netherlands and Germany have to say, okay, we're going to write a check. We're going to support, COVID bonds. And that is basically unifying all the debt of Europe into one pool. And if they don't do that, you are going to ultimately see Italy leave. And after that, Spain and so forth. Because when you look at the flexible exchange rate system, Germany benefits from the weaker euro far more than anybody else does. And I said, I wrote a paper on this when the euro started, and I said, you can't have monetary union without fiscal union. So we're coming to a fork in the road here. And every time the ECB and the EU has chosen to kick the can down the road, they have some, acronym program to the exchange rates stability mechanism, TARP this and TALF that, and TILTRO this, and all these programs. These are all moral hazards. None of this stuff is fixing any of the real problems. And we're not going to be able to fix them until the system collapses. And frankly, if this doesn't do it, I don't know what will. And so to say I'm concerned about the future of the world would be an understatement. But that doesn't matter. Like my view on the weakness of the system, it stems in lots of different ways. I think this guy has, he's likable. He used to have nice hair. He doesn't anymore. But I think he's an economic moron, and the people guiding him are ridiculous in terms of what they consider a fair spend of our tax dollars. And Canada's not prepared for this. So every day at 11 o'clock now, he gives away billions of dollars. He's like Monty Hall now. Whoa, you get some, and Oprah, and you get some, and you get some. And so I'm not just mad because he's preempted my BermansCall show until this stuff is over. But, the government made us stay at home. So they have to do all this stuff. And theoretically, there should be no limit. But again, to think we've bottom and everything's okay after this because they've thrown a lot of money at is wholly naive. So we are going to see aftershocks, virtually guaranteed, and the economies will not fully recover. The lack of investment in Canada's best asset and export is catastrophic in my mind. But taxes are going to go up. L plus NDP plus G. So Liberals, NDP, and Green Party is bigger than the Conservative Party. And I'm not sure where the Bloc would vote on this, frankly. But we've got a majority that probably is going to vote for higher taxes at some point in Canada here. And, when I add all this up, and all the largesse and all the support, gold is got to be the favorite asset class. I first started talking about a couple years ago. I said it was a cheap asset. Watch it. It's forming a base, and it keeps now breaking out, and now we're breaking out again. I've got some charts on this. So you know you've got this guy, leader of the free world, telling us the best economy ever, but the reality is so far different. And I like what Andrew Yang stood for in terms of telling people the truth. But frankly, folks, nobody wants to hear me rant about how bad it is out there. People want their free shit. People want the support, and that's the world we live in. So there's going to be more band-aids, there's going to be more largesse, and it can't be stopped because the fundamental fix, to me, there isn't one. The only way out is debt monetization and going to a world of modern monetary theory, which is wildly bullish for gold. Now, the people that they've chosen, the presumptive nominee, to me, compared to Donald Trump, is a fail, is an epic fail, actually. He's clearly got cognitive decline. His issues with women are not as bad as the other guy's issues with women, and I don't think that's a big thing. But who wins the election in November is going to have massive implications for how the markets behave over the next couple of years, notwithstanding what happens with COVID, on wave 2 and so forth. And interestingly enough, if timing is a thing, first week in November coincides perfectly with the peak of seasonality as we get into the flu season. Right? October, November, December is the beginning of the flu season. And what's that going to look like? So to think we're not going to have more volatility in stocks is an absolutely insane notion. Rosie and I last week talked about some of his charts here, and that the outcome ultimately of this over the next number of years, once we get through the deflationary shock of the hit to the economy, is going to be a stagflation, is going to be anemic economic growth, not the best economy ever, anemic economic growth with rising cost pressures, largely due to policies moving, border walls going, supply chains coming back. Profit margins for corporations are going to get squeezed and squeezed and squeezed. Incomes are going to be rising. Unions are going to be getting stronger. If you don't believe that is part of the future, let's debate it, because I think that that's an extremely high probability. So having set the table for you on moral hazard and what I think the next number of years are going to look like, we've got to navigate the world. We've always got to navigate it. And so when we get to a point that seems unreasonable, and seems a bit euphoric, like we've seen. And like we've seen, by the way, in every other bear market in history, and I'll show you some good charts on these. Because a bear market, folks, it bothers me to no end when the media, and they don't know any better, they're just reading a definition that's written somewhere on the internet. A bear market is down 20% and a bull market is up 20%. That couldn't be more wrong. A bear market is pain and ugly and nastiness, and we're just starting that part. People haven't been depressed. This snapped back so quickly, people are practically giddy again when you look at some of the sentiment surveys and the price behavior in the markets. So you have to understand and what sleep at night is, and what I've been talking about for years and years and years on BNN, is that when the risk factors are high, whatever they happen to be, you just have to take less risk, so that when the risk factors, the blood in the streets and all that Warren Buffett-like value is there, you can take advantage of it. And interestingly enough, Warren Buffett was a seller into this, not a buyer. And what does that tell you when one of the most conservative investors in the value world of intrinsic value and smart buying of good quality businesses pukes out the whole airline industry that he bought into a few years? That tells you that ain't probably coming back, and a couple of them probably go bankrupt, right? So keep that in mind. And taking smart risk is knowing when to make the big bet. And it's just not the time to do that today. So understand fear and greed, understand a little bit how to measure it. If you don't, this is a great place to start. The 7-factor model. I promise that someday it's a pet project of mine to create an indicator, a BermansCall, fear and greed index. I'm not sure what we're going to call it, but for lack of a better name. And it's going to measure some of these factors, a few others that I think are very interesting and helpful into what I look at and how I gauge that when to take more or less risk in the market. And pretty much every dip for the last decade now, we've been buyers. And to my fault, to a fault sometimes, I'm too conservative. I get concerned too early, and sometimes the markets keep drifting because, that famous saying that markets can stay irrational far longer than we can stay solvent. So I'm not going to dig too deep into this, but we're at the point now where we've had an extreme and almost certainly are going to retest that extreme for a lot of the reasons I've already stated. So, when we get there and close to it and lower, I've talked about my shopping list for the last couple months now. I love smart technology. I love the future of the Internet of Things. I love 5G. I love everything that's going to make our lives easier. I saw a video this week that was very interesting, and it was a robotic processing plant for food, and it would take the pork, and it would on a conveyor, and it would slice it, and would cut out the ribs, and it was all robots. And you know what? They're not going to get COVID. They don't get sick. They don't need sick pay. They don't take a day off. And if you don't think the world is moving more and more to that, it is. So a lot of those supply chains are going to come back home, not so much in food production because you don't get a lot of that, outside, other than in Canada, for example, in the winter, we can't grow fruits and vegetables. So most of that, if it's not in a greenhouse, is coming from somewhere with a different climate than we have. But generally speaking, supply chains are going to, but those high-paying jobs, some of them might come back, but really, it's going to be robotics, artificial intelligence, how to use technology to improve productivity. And that's going to be a big part of the future. So, we're in for decades of stagflation. We're in for decades of sluggish economic growth, where interest rates stay very close to zero. And the traditional 60-40, 70-30, 50-50 balanced portfolio, you've got close to half of your portfolio that's going to give you no real yield. The bond part, it's broken. Fixed income is broken. But for now, as interest rates are still going to fall until we see the 10-year testing a negative rate in the US, and at that point, I would be very, very bearish on bonds. But until we get there, the largesse and the amount of money that governments are going to have to spend, we're going to see maybe 5 years, maybe longer, I don't know, of yield curve control, meaning they're going to anchor interest rates like the Bank of Japan has, and saying, we're not going to allow the 10-year interest rate to go more than X. And every time it goes above X, the central bank's just going to buy that bond and paper. And that's the world we're going to live in. And until that happens, gold looks very, very attractive. So in a world of inflation, and very specifically a world of deflation, gold is a very, very exciting asset class for me. Now, I think as we come out of this, parts of the world that have growth potential, lots of parts of emerging and developing frontier markets, part of emerging markets, are going to be very, very attractive. I'm not buying any of them today. I'm not buying any of this today because we have a lot of price risk in front of us. So there's lots of things we could potentially own here, but right now I've got the battens hatched, and we're waiting for the next storm. And I don't know whether it's going to be a year from now or 3 months from now or next week. And that's the part of market timing and being technically based that most people just don't get. A lot of people who fall into technical analysis think that they know. They don't know. I've been doing this 35 years now, and if you are not humble in your approach to the markets, you will get schooled over and over and over again. And what you will learn, and I learned this lesson, and I've written a whole chapter of this in my book, and one day I'll finish that book, but you have to understand that the market is smarter than you are. And the decisions we make about what to own and when to own them are market timing decisions, for sure, but they should be done in context with thoughtful cognitive analysis and not emotional, momentum-driven decision making. And I can't be more clear on that. So, duration, right? So Rosie and I talked last week about interest rates, and we're going to see US 10-year test a negative interest rate for the simple fact that it's the biggest asset pool in the world of safe money where they're not going to default. So every dollar that comes out of every stock market in the world, it's not going to go into the bunds, although some that might have to stay in Germany will go into the bund market at a negative yield. But it's going to continue to seek a positive yield until all the safe yield in the world is trading with a negative. And that, folks, is probably going to be the end of the bull market until they lift the yield curve control. So it could be years still of interest rates staying low, 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 and going even lower than we've seen today. And it's going to be very, very difficult for the average person to have that static balance type portfolio. It just is. So let's talk about gold. Long-term forecast. So Bank of America Merrill Lynch says 3,000. I project out on this long-term chart here of gold going back to the 70s, where I can see over the next couple of years, 3,000, we're heading in that direction. They think by the end of 2018. Well, maybe, sure, why not? I don't know. But it's fundamental. And the fundamentals are very simple. Half of the demand for every ounce of gold that comes out of the ground is jewelry. And the other half is everything else, meaning industrial demand, technology demand. Gold goes into all kinds of computer chips and everything, semiconductors and things. And then there's the investment demand, and that's you and I and everyone else trying to figure out which gold ETF or what slice of bullion or gold coin we should own. And then there's the central banks. And the central banks are the biggest because they can print money to buy gold. And they're going to do that. So it'll be very, very interesting the next few years. Now, let me blow this up and look at the really short-term chart patterns here. So when it comes to technical analysis, so we had this leverage unwind of these risk parity funds where all the leverage got redeemed and they own treasury bonds and they own gold, and it didn't matter that we like those asset classes. When money comes out, they were forced to sell. And we saw some of the triple leveraged ETF equity funds blow up because they had more than a 33% down move in one day, and that blew up the whole NAVs, and there was problems with oil and everything else that goes into these risk parity funds. So that was very, very interesting, probably not to be repeated again, but who the hell knows. So technically, when we look at these chart patterns, we can make projections based on behavior. So one of the patterns is called a pennant or a flag, and you can see the sharp move up there from March to April is the flag pole. We call that the pole. It was $295.82 measured peak to trough to peak there. And then one way of getting a price target is to take the breakout, which today we broke out, and we can measure that flagpole and say that's the next big resistance, a little over 2,000. The red line there is the high from 2011, 1921. So those are going to be some hurdles along the way. And then we have some of trend line projection. So if we take the highs of January and February and project that out, that's going to be some natural resistance for the curve to accelerate above that. and then we can take this little triangle, this pennant here, and say, well, what does the base of that pennant look like, and project that out and say, okay, the next technical target somewhere early mid-June is probably in the low 1800s. So there's all kinds of ways to forecast and project and pontificate about where gold's going to go. The answer, folks, is higher. And I don't care how you own it. You buy gold bullion, you can't trade that. You're not going to go down to the Scotiabank gold window or to the merchant and trade your gold back and forth. For investment purposes, the most liquid ETF in the world is GLD, and I don't care if it's not fully convertible. But if you are of that mindset, and there's some questions that have come in on that, Purpose has a convertible ETF. You have to have a full board lot or creation unit in order to redeem those for bullion. And for many people, that's hundreds of thousands of dollars. So they claim you can convert it, but you have to have a huge size. You can't buy 100 shares and think you can convert that into gold. And don't let them fool you otherwise. And there's big costs in terms of converting it and taking delivery of the underlying. Don't make that mistake. So if you're holding gold because you like it and you're as an investment thesis, then just hold the most liquid one, the cheapest one to trade in the currency you want that exposure in. That's it. And whether you hold junior gold mining stocks that have 3 times the leverage and volatility as bullion, or the seniors that have 1.5 to 2 times the volatility and potential, that's your call. I'm not going to tell you which one to own. You know, I own some of the BMO one, I own some of the GDX, so ZGD. It doesn't matter. They're all going to give you a similar type experience, and it doesn't matter what you own. Okay? So that's my 2 cents on gold here. Okay, technology. So here's where we've got the Internet of Things. We've got large cap tech, biotech, the NASDAQ, robotics, cloud, software, cybersecurity. I love them all. They're all grossly overbought. I wouldn't buy any of them here. I wouldn't short them. I'll buy them on pullbacks, but right now I don't want to own them unless I own them with a hedge, meaning I've minimized the market risk of owning them at these levels, which are not fundamentally attractive, but closer to the lows in March and lower in many cases, those have now become fundamentally attractive. Warren Buffett-like intrinsic value, if you will. And that's where my portfolio manager fiduciary duty hat comes in, where I'm making good decisions for my clients, not based on emotion or momentum, based on rational investment thought and behavior. Okay? Emerging markets, I've talked a little bit about how to play them, but at a macro level, frontier markets, more interesting to me. Would I own them today? No. There's price risk in all these things now after the rally. Okay, closer to the lows, below the lows, shopping list comes out, we get more aggressive at that point. When is it going to happen? I don't know. And for those of you who want to buy today, you know, consider ZZZD for the yield seekers out there. But my favorite ETF, which I asked BMO to create, I said, build me an ETF that diversifies across all the sectors, takes the best ideas from the put right strategy, and that's where we write puts to buy the companies. The first iteration of that BMO came out with, there's no way of saying it, it failed. It was a bad execution. And I feel really bad about that because I was out there saying, take that, combine it with ZWH, and the two of them together give you a yield of 5 and a 5.5%, 6%, and give you a sleep at night experience. And they did. They actually did when you looked at them together. But ZPW did so bad. So what I went to BMO and said is, listen, I don't want you, I want to actually own these great companies. I don't want you to flip them around and take the loss when you get put to stock. I said, make me an ETF that actually buys those companies and then writes a call to sell them where you want to sell them. And so that's what this is. This is a buy low, sell high ETF that has a yield of 5, 6%. And if you can handle some volatility, remember markets fell. This is since it was created here in January, not since the beginning of the year. Markets fell from peak to trough more than 35% in the US, with dividend stocks falling closer to 40%, 45 from the extreme peak to the trough. And ZPW, ZPAY, sorry, went down 2022, as you can see on the chart there, and has now snapped back as of month end to very, very good levels. Same thing for the Sleep at Night Dividend Fund. It went down way less than the markets. Now I'm focused on dividends, and dividend stocks did terrible through that decline. There's nothing I can do about that because I gotta get a yield for people. And now that snapped back as well. And Purpose has the premium yield fund, which is very, very similar to what they do, but it's a different active management than ZPAY, and maybe you want to own a little bit of both of them. So know how they work. This is a great, great holding that you could buy today. Now, if we go down, it's going to go down. But for the yield seekers out there, ZZZD or ZPAY is going to give you a much, much better experience for people who need that yield to live off of. Okay, very, very important. Now, the last two charts here, before I go to some questions, are the bear market rallies. And what I'm pointing out to you in the 2000 to 03 playbook and the bear market rallies that we've seen, you have some face-ripping rallies. Now, think about this. You get this rally that's more than 20%, and the media says, oh, you're in a bull market. No, you're in the throes of a bear market. It just hasn't fully played out yet. Again, it's a pet peeve of mine. The media just doesn't get, oh, we're 20% off the low, we're now in a bull market. Wrong, wrong, wrong. I've told every colleague on air on BNN, stop saying that. You're wrong. You're making yourself look wrong. We are in a bear market, and it's going to still get ugly because you have the initial shock, but Rosie and I talked about this. You have the reflexive rally or many reflexive rallies, and it's not over until there's complete despair and nobody wants to own stocks anymore, and we're not even close to that at this point. And then it has to stop making a lower low. And it's very, very clear that as long as we keep making lower lows and lower highs, we are in a bear market. Make no mistake about it. So in order to go back into a new bull phase, we got to go above 3,400 on the S&P 500. Let's look at the Great Depression. Let's look at the break of the 1929 bear market using the Dow Jones Industrial Average. We had a 48% rally from the early lows in 1929 until the first few months of 1930. And then the economic realities start to kick in. And so if there's no vaccine for COVID and they don't have a great viral solution, and we don't have herd immunity for 2 or 3 more cycles of this, which is the estimate, if there's no vaccine, it takes 2 or 3 years, like the Spanish flu, to work through, then this is going to be what the market looks like for the next few years. And the only question is, how low does it go? And I don't know is the answer. But look at some of these face-ripping monster rallies in the throes of a bear market. It's completely normal to see what we've just seen. So stop questioning it and understand the big picture and the macro environment and what it means for the world. And most of your questions are going to get answered in that regard. So let's go into some prepared questions people have written in, and then I'll go to some live ones, and we'll have lots of time for that. So life cycle of the pandemic, the effect of the ongoing situation will have on the economy. Do you think the markets will hit a second bottom like they did on March 23rd? If so, when? So Wendell, I don't know when, but it could be that second wave. It could be after the next quarter of earnings and companies say, we didn't know after the first quarter and we don't know any more now, and we're taking even more guidance away, and There's no vaccine coming. Until there is, our people aren't coming back to work. We've told people to come back, they're not coming back. So maybe it's that discussion, and that'll be in July into early August, or maybe it's not until the second wave of the seasonal flu. We just don't know. But the probability of at least a retest is extraordinarily high, and more than likely an undercut of those March lows, Wendell. What's your view on the extraordinary gains in technology? So I addressed that. Does it continue? So again, Greg, this is a fear of missing out question. I think I've covered this in my analysis tonight, but stuff is working. Companies are actually growing revenues, and that's where the money seems to be catching. It's the Amazons that are actually hiring people and so forth. So there is that huge part of the NASDAQ, those 6 stocks, Netflix, which is working with more people staying at home, Amazon. Apple, I think, is the wild card here because, yeah, they've got some cloud and this and that, but they sell devices. And we'll see what happens when the stores open, but I'm willing to bet they're going to miss significantly on sales. We're seeing data coming out of China now. Traffic data, air pollution, it's kind of these other ship loadings. And so we saw the initial bounce, and now we're seeing it all these data points start to roll over again in China. Very, very interesting. And let's watch that closely. But so the markets are going to roll over again here. But I love technology. These are go-to names. You want to buy the dips. I'm not buying them today. Mr. Berman is bullish on gold. Yeah, I am. And I talked about it. And I talked about, what do you want to hold and what are the risks? What are the risks? So gold stocks are twice as volatile as gold bullion. There's no guarantee that the company manages well. Maybe they hedge too much. They don't participate. There was a thing years ago as gold prices were going down that the managements were always forward selling their next year and the year after and what they expected to take out of the ground. And that made sense when gold prices were falling. It makes absolutely no sense when gold prices are going up. So companies that do more forward hedging because they have higher cost and they're more at risk aren't going to participate as much. And that's very, very simple analysis if you understand how gold stocks. So there's a lot of things to consider, Frankie. Don't worry about the individual companies. Get the theme right. Own some bullion, own some large cap, own some small cap, own some silver miners. Get the exposure. Don't worry about the company specific risks. Get the theme right. I can't overemphasize that enough. Rosie has stated one of the best ways to protect is long bonds. So I talked about duration. And so there's all kinds of different ways to play duration. And there's different holders. And, is there a less expensive way? Like the MERs for these bond ETFs are dirt cheap. I wouldn't worry about all that stuff. So long bonds, TLT is the one I use. BMO has a ZTL, which gives you a hedged exposure. There's a US dollar version of it. So have a look at some of those. How you choose to play it, listen, I'm indifferent. I don't care. Those are the ones that I use. If you're trading and actively trading, you don't want to use any of these except for TLT because that's the big one. It's got all the liquidity in the world, but you need a US dollar account. It trades in US dollars. Doing that in a Canadian dollar account where you're paying FX charges is too expensive. Canadian banks have drastically fallen with deferred. Excuse me, I'm gonna have a quick drink here. Defaulted in deferred loans and mortgages. The biggest risk beyond their lending risks are the risk of net interest margins flattening, and that's that inverted yield curve and flat yield curve, and that's going to be with us for a number of years. So while the dividends are relatively safe, and I say that with a deep breath, the risk that the Canadian banks get cut in half still from where they are today is a very real risk. But the recent high in ZEB was a little over 30, and I would say half, 15, 16 area is where I get very interested, the most recent low being just around 18. So lower for those, and I wouldn't be aggressively owning them. But if you're going to own banks in the world, we have some of the best. And from that perspective, on a relative basis, I like Canada better than some other places. What's the best strategy in the present economic environment for an investor to combine the use of sleep at night ETFs with ZPAY? Well, ZZZD is me managing that risk for you and me making those bets for you. So Marco, I can't think of a better way to go than with me. And that's not a self-serving thing. I think I'm a bit ahead of the curve as it comes to being active in markets like this, probably along the lines with most others. And in fact, we've won several industry awards over the last number of years for our sleep at night funds. I suggested several times buying hedged ETFs in the Globe and Mail. An article suggests that unhedged ETFs are better for several reasons. Okay, well, so that speaks to a couple different things. Generally, the rule of thumb is because the hedge costs you money that you don't want to hedge. And that's probably was the main point of the article. I didn't read that, TH, so I'm not sure. But I'm pretty sure that that was probably one of the main reasons. Now, the cost of hedging in any given year is the interest rate differential between the two currencies, plus the spread of doing the cost of the bid-ask spread. So, and most of these ETFs roll every month. So there's a bid-ask spread, so call that 10 or 12 basis points a year, and the interest rate differential. So if Canadian rates are higher than US rates or US rates are higher than Canadian rates, you factor that in. And if it's Canada, Europe, and so forth. So for Canada, Europe right now, you actually get paid to hedge because of the interest rate differential. So you got to look at things like that. So where are yields more expensive, and where and so I can actually make money on the hedge. And so I didn't read the article, but there's a lot of different factors. And for me, I would rather pay a small amount of money for the hedge and know I'm going to get the market return. But when I look at the currency, and I think of currencies as a separate asset class, and that's why I talk about this. So I take a view on the currency that's independent of the view on the market. And with ETFs, we can do that. When you're picking single stocks, you can't. And so if I'm going to buy the S&P 500, I want to know, or the NASDAQ or any other index in the US, I want to know what's my Canadian US dollar going to do over the horizon I'm thinking of holding them. And if I don't have that view, then it doesn't really matter. You have to have the currency view. And if your view is for the Canadian dollar to weaken, then you do not want the currency hedge. You want to own that foreign currency and have it appreciate for you. But if the view is the other way, why get hurt? If the view is the other way and the economies are strong and we're going to export more oil and it's going to be great for Canada and therefore Canadian dollar is going to rally, that ain't happening anytime soon, by the way. But if that was the forecast, then you would want to buy a currency hedged ETF, because then the expectation would be the other way around, for the Canadian dollar to strengthen. And when you own a US dollar asset, foreign asset, then you're going to lose money on the currency. One of the slides I show being show hedging, buying put and sell call. So yes, could I elaborate and give more example of what I do in my portfolio? So this is the collar I was talking about, a collar strategy. And so you can buy a put, and that costs money. So if you buy a put to protect your portfolio, it's going to cost you. And right now, to protect your portfolio at the money through the end of the year, probably going to cost you 8 or 10%. Not cheap, because volatility is high, so it means it's expecting broader market moves. But there's a strategy called a collar, which is a synthetic short. So it's similar to actually shorting the ETF. or the index. And you could take index options or ETF options, and you buy a put and you sell a call for about the same price. That's called a collar. And it's synthetically the same as shorting the stock, shorting the ETF or the index. And that strategy doesn't cost you anything. The market goes up, you're short, but theoretically what you're long is going to offset that. So the idea in a collar is being long stuff you think is going to do well in up or down markets, outperform, generate a yield for you, whatever. And the collar hedges the market beta, the market risk. And so you're running a market neutral strategy. But if you think you're a good stock picker or a picker of sectors like Renee was talking about at the beginning, then you can be in stuff you think is going to do better, and you can be market neutral from a risk perspective. And that's hopefully, Steve, that explains a little bit of what that was. What are your tipping points going forward, which should give comfort or concern about the shape and length of the recovery? I've talked a lot about that already tonight, Jimmy. There's so many wild cards out there. Big tipping point in the next few months coming with Europe. I think what these crises reveal ultimately, Jimmy, is that the emperor or who has no clothes on, who's been cheating, who's been masking things. So you're going to see a lot of corporate frauds be uncovered. You're going to be seeing corporations that have been hiding shit for years. All of a sudden they can't pay or something happens. You're going to see another Bernie Madoff come out of the woodwork somewhere for sure, right? So all that's going to, and so who knows what tips the balance. You're going to see an AIG, you're going to see too much leverage somewhere explode. And listen, the moral hazard is a big thing, and it's allowed companies to borrow money and buy back stock and enrich the C-suite, and that's just simply not going to be tolerated in the future. And it's going to be more about corporate governance and doing things right for people and the employees. And I'm sure the world's heading in this direction for the next 100 years. Who knows? But we need a change, because the system that we built for the last number of decades has failed the bottom half in a gross way, to the point where a person like Donald Trump gets elected president. Okay, I can't tell you how sick I am that this guy's president. Pardon again to the people who like Donald Trump. So like many retirees with interest rates so low, I need some additional yield and equity. So ZZ's part of my portfolio, but I'm considering adding ZPAY and the Qs or the quality index. Would you recommend one or combine all of these for a 5-year horizon? Don, the answer is absolutely yes. I would recommend them. ZPAY, I'm okay with buying it today because it's a low vol, sleep at night risk, but not the NASDAQ here and not the quality index. I would save those for when the market's next correct in a more meaningful way, to a point, Don, where not I'm comfortable with it or Larry's market call, but Don, where you're comfortable with it and your market call. And you know, what's basically good for you. So I brought up here my Bloomberg screen, and I'm going to take some live questions here because a lot of them get sent in and people take the time to ask, and I don't get a chance to get to these. So question here on semiconductors. So let me look at the SMASH ETF here. So again, semis fall into the space of tech that I like a lot of. So let's have a look at it here. It looks like a lot of tech indexes, you know, massive run up. If I look at a longer term picture here, where do we like this thing? So where's intrinsic value? So fundamentally, if you looked at the big names here, AMD and Intel and so forth, and you look at where the value is there and where some of the analysts have those price targets, and so where's value? So to me, 80 to 100 range on the charts. So again, retest of the lows, lower lows. That's where, from a value perspective, it's interesting. Is a correction going to stop there? I don't know. Are microchips, is technology going to be a massive part of the future of robotics and AI? Absolutely. And so the only question is risk and return and volatility. And if we have a lot of market risk in front of us, it doesn't matter how great it is, it's going to go down. Because at market bottoms, 90% of stocks are well below their 200-day average. I'm going to show you a graphic here. This is the value line breadth index. And value line is an average, it's measuring an equal weight average price of the stock, what it's doing, up and down, up and down, up and down. This chart is going back to 1987, which is very, very interesting. I showed this this chart this week here, or was it last week on the show? I can't recall exactly. So this red line across here is drawn across the peak of the market prior to the 1987 collapse. And as we draw that line across, at the most recent low, we bottomed out at the same level the market peaked at for the average stock. Hear clearly what I'm saying, at the 1987 peak. So at the recent low, the average stock has not done any better than it was at the peak in 1987, more than 30 years ago. Now the trend of this index, so this is a linear regression that measures trend, and it gives us the slope. You can see the slope of the average price is 2.93%. So the average, the rate of increase of the average stock has been 2.9% since the peak of 1987. And if I ran that number since the peak of 1998, this is interesting, right? Oh, geez, I figured that would happen. My internet just went down on me. I'm not sure if I'm still online here, guys. Let me see if I can.
We can hear you, Larry. We can hear you.
You can hear me? Okay, so I think my Bloomberg terminal just timed out on me. So that's unfortunate here, but let me see if I can be able to log back in here. So apologize for that, folks. So there's the semiconductor. So without Bloomberg here, let me go into some other questions here. So that was Nora. Something smells in this market right now. I think I've addressed that. Let's see here, more questions. Do you think Canadian bank CIBC is yielding 7%? It's looking juicy. I gotta say, Jeff, I talked about the Canadian banks already. There's a scenario, and it's not real. It's a real scenario where the dividends in the Canadian banks get cut. It's the last thing they're going to do for sure, but there is a scenario where that plays out for sure, and we've got to be very mindful of that. What best signals determines what stage of the business cycle is active? Are we moving to a new stage? There's no indicator. We can see a lot of movement in the business cycle, Alan, based on what sectors are leading. It's thought of late in the business cycle, you get a lot of inflation. You get full employment. This cycle was very, very different than every cycle we've ever had, because there was no inflation. Powell talked about this yesterday. He said, this crisis, the reason we're doing all this is COVID. It's not because it was a bad economy. Well, I beg to differ, because when you started raising rates in 2018, it was a bad economy and you had to cut rates again. So I beg to differ, and I believe the chairman of the Federal Reserve is now at the point where he can't say certain things that others now are saying, like a Ben Bernanke or a Janet Yellen, and even Greenspan as of late. have come out and said what they really believe and how fragile the system is that they could never say when they were head of the central bank. Very, very interesting. It'll be interesting to see what Stephen Polo says. Now, they don't come out right away and say it, but Bernanke's been out for a while and he can now talk freely, and certainly Greenspan can. He's been out for a long while. A lot of people blame Greenspan for this crisis because he was the first one to do the put. Does Larry manage a fund or ETF that's tax efficient in a registered account? Well, first the matter is, in a registered account, tax efficiency doesn't matter at all, because the tax implication comes when you deregister the money. Okay, so Victoria, so the taxability of the ETF or fund does not matter until you take that money out of your registered account, and then it's all income. So it doesn't matter what the sources of returns or how they're generated, by capital gains, by dividends, by income. Okay, so there you go. Now, in a non-registered account, the rules of the government, CRA, there's a preference for taxable dividends from a Canadian corporation, which I believe in the context of the next number of years is going to change significantly to help pay for this. They're going to move towards neutralizing benefits for capital gains and dividends. And they tried to do that before. So you are going to see some tax changes there, and I would consult with your tax advisors. What sectors should we concentrate over on in the next 12 to 24 months? I've talked about the importance of technology in the future. It's going to be very, very big. Parts of emerging market look very attractive to me. Can I recommend an ETF for junior gold miners, Claudio? ZJG, BMO Junior Gold Miners in Canada. GDXJ is a US ticker. What else do we got here? A few minutes left before we have to wrap. I had a look at the gentleman's name is Adam Posen. Yes, Kat, thank you. It is Adam Posen from the Peterson Institute that was interviewing Powell yesterday. Is Larry suggesting sell the Canadian banks? No, Tamar, I'm not saying we sell the Canadian banks now at all. But I think they could possibly fall another 30 to 50% from here. And if you think that's a risk and I might be right, then govern yourself accordingly. But if you need the dividend yield, and where are they going to be 3 or 5 years from now, I wouldn't sell them. So I can't answer that question for you, and I'm not recommending you sell them. Very, very clear, people. I'm not telling you to go out and sell everything, because the market may or may not correct. I'm sharing with you my view. I'm sharing with you the probability of my view. I'm sharing with you how I execute my view in the various funds that I manage. I am not telling you to do anything. Okay, please be very, very clear. In fact, if I am telling you to do something, I'm telling you to understand where we're heading in the future. And I'm telling you that the most important thing you can do in your portfolios is sit down with a financial planner like the ones we have at U Potential and understand what your future looks like and how much risk you should be taking in your portfolios. And if that's not the most important lesson from tonight, I don't know what is, because market calls are a dime a dozen. Now, I happen to be right more often than I'm wrong, but I'm wrong a lot. I'm probably wrong 30 or 40% of the time about my timing and duration of what's going to go on, and nobody can time markets. And I say it over and over again. So thanks for that question, but I hope that really gives you an answer there. How would negative interest rates be applied? Could I borrow 10,000 at a negative rate? No, that's not your, Franco, that's not your negative interest rate. That's the central bank and the borrowing interest rate. Your rate is always going to be positive. But if you leave money in your bank, not only are you going to pay a fee, but you're going to have to pay a negative interest rate. Now, that transmission screws up all the money market funds. And the money market funds in Japan and Europe are not as breadth and depth as they are in North America. And that's why they don't want to use negative rates here. And it causes a lot of problems in money markets. But no, Franco, you cannot do that. Now, if you're eligible, you can short a government bond at a negative interest rate and earn that negative rate. You still have to pay the coupon, but you earn the negative rate. So it's all about yield to maturity there. So you got to understand a bit how that works and effectively give yourself a negative borrowing rate. And then you have to repo the bond. And if you understand what I mean, then Franco, you too can borrow at negative interest rates. Folks, it looks like we're out of time here. So I'm going to wrap things up here with an ask and a thank you to all the people who have tuned in tonight. Please, if you're interested in anything that we do and that I do for BMO and ETF Capital Management, please visit ZZZ Portfolios and for BMO and visit etfcm.com if we can help you customize an ETF-based portfolio for you, tailored to your level of risk. Our fee-based financial planning service called U Potential. Or if you're interested in a bit more education from a different perspective, from the perspective of our better halves gentlemen, Golden Girl Finance, it'll be a very interesting platform. And for the other portfolio managers and advisors out there, go have a look at the Q Wealth platform. Thank you, everybody. Please help support leukemia and cancer research at the Sick Kids Hospital. And Jared and I will be happy to match those donations, or dementia and Alzheimer's research at the Baycrest Hospital and Foundation here in Canada. And both these institutions are world leaders in their class, just like what we try to do here in generating some world-class ideas for all our support here. So thank you very much. We'll see you all next week.